I think Trump is in a very sticky spot here. That is where I believe they're trying to go. That's from everything that I've heard and all they're talking about. Why this is important? Because this does directly affect interest rates. That is the number one driver. Take everything else away, you guys. The number one thing for self-storage that this administration or any other administration would have done, it is welcome everybody to Self-Storage Income, and it is the day after the elections. So how is this going to affect the self-storage industry and your investments? So, wild night last night, of course, wild day today. The results are in. We now know markets are reacting. We even have words out from the Fed. But Connor, what are your first thoughts?
My first thoughts, man, today is the first day. Like I was telling you before the podcast, I mean, I haven't really had a whole lot of time to even digest what's going on in the markets. Talking before the podcast, it sounds like markets are already responding in a really positive way, up 1,400%.
1,500 now.
1,500.
Soaring. Just
totally insane, which obviously, you know, you see some of those things, Treasury yields going up, you know, that therefore correlates with the interest rates. And so I'm curious, I don't know what your thoughts are, but given from, you know, previous and past experiences, do you think interest rates are going to go up? Do you think, because I'm in my head, I'm like, what's going to be the biggest impact to self-storage, you know, buyers, sellers, all of that? Interest rates.
Interest rates, yeah. First of all, for those of you tuning in that weren't keeping up, a red wave is an understatement. He won the popular vote. He won, I don't know how many, 300 of the delegates. They're still counting them and it's still coming in, but he's ahead on all those. They declared it before even midnight. The Senate went to the Republicans, and it looks like the House is too. So this was a complete land blast just across the board. And that actually makes a big difference when we're looking at markets. The reason being, everyone, is if they control all the branches, they can get things done. So if, let's say, the Trump administration had won, but they didn't have Congress or the Senate, it could be in total gridlock. Whereas if they control the Senate, Congress, and the executive branch, now they can push things through. And as I was last looking, it looks like they have a pretty good hold on the Senate. And from the last time I checked, the House was moving that way. And it looks like that's going to happen. The markets are reacting on twofold, good and bad. Now, this discussion, when we look at it, we're looking at why markets are reacting, what it means to us. This isn't meant as a political statement, but a reality because we care about our money, where the money goes. And I'm looking at the industry because I want to know what's going to happen. So there's two things. Trump is not, I think Trump is in a very sticky spot here because on one hand, they seem to be able to get a lot done because of their control. But we have to remember, inflation is very sticky right now. Even with interest rates where they're at and everything, we've got inflation rate down, but it's not even at core. And we don't have job losses. We don't have, bankruptcies. We don't have any of that kind of stuff. So the economy is still moving forward at high interest rates, and inflation isn't, we're not in a clear path here, as in the economy seems very sensitive still, right, to money. Now, the money supply, because at the end of the day, the money supply, you increase it, right? That increases the overall demand for capital to move in the economy. That creates assets moving up, and they increase the money supply by lowering interest rates. That creates activity, GDP growth. That also creates inflation. So anytime you have growth, you have inflation. So when you have the economy growing, that is an inflationary effect. Inflation is a good thing when it's under control. It's a bad thing when it's out of control. Too much money tips the balance. There's too much money chasing goods and services, so prices go up, 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 and up. The money is getting worth less and less and less. That spread, right, can really hurt consumers if their income is not going up with it. Normally, what we see is during expansionary times, you have low interest rate, debt's moving, and the economy is growing. You'll get a 2.5%, 3% inflation rate with the growth, and that's good. That's what you want to see, right? You then want to see incomes outpacing inflation, and you want to see that capital being used to put infrastructure on and on and on. Once the inflation gets to points like we saw, you have to get rid of the money that's in the market. That's the cause of it. There's too much money. We got there because we printed trillions of dollars, vastly more than we ever should have even remotely got close to. We put too much money in the supply into the system. It's important to remember, everyone, it is really easy to put $4 trillion into the economy. You just send people checks. You start buying up assets. The Fed, the printing machine turns on, you drop interest rates to nothing, and money just flows in. To get money out, that is totally different. Once the money is in the system, it's in assets, it's in bank accounts, it's in cash holdings, you have to get it out, but that means when you contract the money supply, that's generally a recession. So trying to get money out without destroying the economy, that's way harder. You can't flip a switch and pump $4 trillion in and then flip a switch and take it back out. It does not work like that.
It's like some massive detox, right? You're getting rid of a disease, and it's
exactly.
How do you keep the body alive? But yeah, get rid of the disease kind of a deal.
Bingo. That's exactly right. We still have that money in the system, right? It's not gone. So the key thing is right now, the markets are reacting for growth. That's what we're seeing. That's why even interest rates are rising, because they're anticipating growth. So when you look at that, the markets, everybody's anticipating market growth, which means at the same time, okay, we'll have an inflationary effect. And that means that interest rates will either remain high or need to remain high. That doesn't mean they have to. And let me tell you why. So there's a few things that I think the Trump administration could do. The first thing is what their plan is that they want to cut government spending. So to give you any idea, the last three bills were tiebreakers, and Kamala Harris broke the tiebreakers. She was the one that signed off to do the spending packages, which were over $2 trillion. They spent $500 billion in the last 3 months, like 2 months or something, like crazy, like wild amounts, more than we've seen in any peacetime and anything outside of we're spending more than we were during the great financial crisis, and there's not even a recession. Nothing's happening, yet the government is spending astronomical amounts of money.
Unreal.
That makes it really hard for the Fed at high interest rates to offset the money supply, because the government now is making up so much of the economy. We see this with jobs. Most of the job growth came from where? The government. The government is making up the economy, and it has kept it in this way. If they go in, and Trump's plan to go in and basically chop up a lot of the Fed. He's talking the federal government. They want to reduce staff. They want to reduce redundancies. They really want to get rid of bureaucracy. That's been a big thing. And Elon Musk has talked about this. And he's talked about partnering with Elon Musk to go through and do this. This is actually where I see the avenue, meaning that transferring economic growth to the private sector outside the government. So right now, the vast majority of the growth we're seeing is government. It is. We can see it in the numbers. It's not a question. Job growth, actual money going into the system, the borrowing, the debt, on and on and on. It's making up a huge percent of the GDP. If you can get rid of that, that is a deflationary effect. You will shrink the money supply. You are going to shrink demand. You're going to lose jobs, right, from the government. And if you can offset that with the private sector, then you can do a transition where the growth comes back to the private sector. It leaves the government. You're not overdoing the system because you're stopping that inflow of ginormous trillions of dollars. The question, though, is that, are you able to pull that off? That is not simple. It sounds simple, but one, you control. He could literally just shut the faucet off to the government, right? They could stop spending. They could start cutting things. but you can't flip it onto the private sector because the private sector has to do that, not them. That is where I believe they're trying to go. That's from everything that I've heard and all they're talking about. Why this is important? Because this does directly affect interest rates. And the interest rates will primarily be held based upon inflationary effects. So the overall demand for bonds and buying up bonds and the government and where they're setting interest rates, how the Fed looks to basically set the cost of money and what the Fed is going to do. Are they going to cheapen, make it more expensive? As of right now, the Fed is expected this week to go through their lowering of interest rates. Okay. Now, that doesn't necessarily mean, though, that interest rates go down. They already did that and interest rates didn't go down.
Yeah.
So it is not quite that simple. Okay. If you have, though, an economy that is shrinking, if you have or you think you're going to be in a recession, you have a race to bonds. The more people want to buy bonds, the less yield you have to give somebody because there's more demand. So if you guys have a bond and I have 10 people that want that bond, I can be like, I'll pay you a 2% yield and 5 people may still want it. Now, if I have a bond and nobody wants it, I may have to go to 5-6% to sell the bond. Well, the reason why they wouldn't want it is because they want to put it into the economy because they're going to get growth. And they believe that growth is happening. So I'm not going to buy this low yield bond. If I think that, though, if I'm saying, all right, I'm going to put it in the economy, it's going to grow. We need to entice more people to buy the bonds, right? How do you do that? Increase yield. You want to get people to come buy the bonds. So this is the reaction you're doing. So the private market, in unison with the government, this is where we see the overall effects of yield curve and where the money or the cost of money and debt. So just because the government, over time, the government will set those interest rates and they'll go lower, they're balancing it with economic activity. We should see the Fed, all they can do is try to change the money supply. They don't have control over government spending. So if the United States decides to spend $5 trillion next year, the Fed doesn't control that. They control interest rates. And if they're like, hey, inflation's going up, we got to up interest rates. So if that makes sense, the balancing act, how that plays out, if we can move into a economic growth period while reducing the amount of money supply, you will have this wonderful equation where we can move into it. I believe that in the short term, that may be rough. So in the short term, we need deregulation. We need to shrink the bureaucracy. That is so, it's a funny thing, but it's actually true. Have you seen the peanut thing?
Mm-hmm.
Yeah,
I have.
Right? The peanut squirrel. Ludicrous. But it is the absolute epitome
100%
of government bureaucracy, overreach, and ludicrous that comes to a bloated government.
Exactly right.
Basically, what we're talking about is, I don't even remember which branch, SWAT team came in, busted into a nonprofit that did rescue animals. He had a squirrel that they had rescued. That squirrel was on Instagram because it gave the nonprofit money to rescue things like horses and things like that. Well, they didn't have either a permit or something to have the squirrel in the house. So they busted in like he was a drug dealer, like SWAT teams, assault rifles, took this little squirrel that was their pet that lived with them, killed it. And it's kind of like this dumb thing where you're like, oh, it's a squirrel and everything. But I think what it stood for and why it became so big was the absolute insanity that the government is doing this.
Right.
When
you think
all
of all the resources
things that you could be doing, like what a squirrel? You're busting down doors with SWAT team squirrel. And so I think that that is the thing in play, that it's like, if we could reduce that crap, get rid of that crap, make the government more efficient, right? I'm all about that. I'm all about the Fed being more efficient, getting rid of the fluff, all that.
Absolutely.
So now the key is, though, and what we will wait and see is, can they pull that off? Can they actually do that? Or is everything that they're going to try just become inflationary? Because things like tariffs are inflationary. They are. You put tariffs on a country buying, or we have goods and services coming into the country, all you're doing is tacking on 10% to the price of the product that we get. So tariffs by nature are inflationary. That is going to be the defining, not just principle, but economic test that they will face. And what we generally find, though, is when you wean a country off government spending and try to move it to the private sector, there is a contraction period. We saw this in, what's the country down in South America, where he just went like to the chopping block and he reduced the government size by he said that when he got elected, he's like, guys, everybody, it's going to get worse. So he actually told them, he's like, it's going to get worse before it gets better. Are you a new self-storage investor and want to know what that facility is worth, what the risk is, how to underwrite it? Well, that's exactly what we do in a feasibility study. A feasibility study, we actually look at the market for you. We look at the finances, the underwriting, we show you where the upside is, the downside, and all the risk. That is actually what you can provide to banks to get capital and investors. It's a big worksheet, which most banks actually require. So if you want to know what a storage facility is worth that you're looking at, come to us, follow the link in the show notes, and we will tell you. So can they do that? Or do we have so much cash in the system that we're so sensitive that if markets go up and people start spending more, we get inflation, and then the Fed has to go raise interest rates, and they basically have to push the US economy into a recession. Recessions shrink the money supply, you eradicate debt, which debt and money are the same thing. They're not any different. So if you have all of these businesses, all of these people that own homes and, corporations, and they go bankrupt and you eradicate $2 trillion worth of debt, you eradicate $2 trillion in the economy. So that is why recessions are deflationary. So governments, to stop selling of assets, they lower interest rates, they flood the economy with money, then people buy assets. Why? Because the money's value is going down. This will define storage, everybody. But it's more than that. Now that we have Trump, the great things are he's pro-real estate, obviously. So we're hoping the Senate, the House, and Trump, we're going to get 100% depreciation back. Want that. I think a lot of these things are going to be very good for real estate.
Good point. Yeah. Trump
in general will be better for, I think, in the long run, even in the short run, for real estate owners. He will. His policies are more favorable for commercial real estate, right? I think that his policies will have other effects that may not be favorable. Once again, on the tariff side, things like that, there's going to be some contraction and hardships in times. That's how any presidency works, right? It's just picking and choosing. We just happen to have a president for self-storage that bringing back things like accelerated depreciation at 100% or 100% depreciation, and a pro-growth president. And if we can get that to be mixed with lower interest rates, that will be a boom for self-storage, an absolute boom. That's obviously what we are hoping. And we would hope that no matter who got elected.
For sure.
Right? Obviously, Democrats controlled everything. I would hope that they're going to help us.
Yeah.
That's all we want, right? That's all we want.
That's what they're there to do.
That's what they're there to do. So
pursuit of happiness, all that,
exactly. And so I really see the Fed, though, is this week going to reduce rates again. We'll see how this affects things in the economy. We're going to see, moving forward. He has what is called he calls it their dream team, right? And already the information coming out, like RFK Jr. already is like, we're rehauling a lot of this. And I think that it was over $2 trillion that Elon Musk proposed that they believe they could cut out of Fed spending. And this is the guy, in fact, he made a post with him carrying a kitchen sink, like in the White House. And so to give you any idea what that means is he bought Twitter. And he's like out with everything in the kitchen sink, and he has a picture with the kitchen sink of him and Twitter. He reduced the workforce at Twitter by an astronomical amount. And the company still performed and did just fine. Yeah. And that became the staple of, wait, you got rid of 60% of your workforce and nothing happened.
Everything's good to go.
It's like, what were all those people doing, right?
Exactly.
How is that possible that Twitter can they have more users today than they did at a 60+% workforce, right? That is what the symbolism of that is, because he is working with Trump, and the idea is that we can do that. Theoretical. These are all plans that they have, okay? Those are the main thing we need in storage. We need the asset side. We need the depreciation. We need appreciation as far as everything growing. But most importantly, take out the buying and selling of assets and interest rates on that one. We need interest rates to be lower so people start buying and selling homes again.
Yes.
Actually getting the homes and people moving. That is the number one driver. Take everything else away, you guys. The number one thing for self-storage that this administration or any other administration would have done, it is get homes moving again, buying and selling. That changes everything because that means we have more demand, we can increase prices, net income rises, and that makes things better. I don't care so much about the buying and selling of assets as long as they're performing and moving up. The short-term fluctuations and that stuff with interest rates on the buying and selling, who cares? It's the housing, though, we need. We need that market to be robust. And it is not right now. And it's not because of high interest rates, high housing prices. I'm not sure exactly what they're going to do to try to take care of the housing problem in the United States. I don't know theoretically if they can.
Yeah.
I'll be frank. I don't even know if they can.
Yeah, well, and that's kind of the thing too that I think so many people get hung up on is they think that, oh, hey, this guy's going to get elected or this person's going to get elected.
Solve our problems.
That's this knight in shining armor, and that's not really the case. And you should never want that anyways.
No, you shouldn't.
You don't want that level of control over your life that you don't have. And, talking through all of these things, we're talking a lot about the macroeconomic impact that these things have because outside of that, there's not really a whole lot of impact that, again, we'll use Bob's storage down the street example. Like it's not going to have a huge impact.
That goes straight back to the fundamentals and focusing on everything else, which is what you want. The biggest impact is interest rates, like you said at the beginning, right?
Yep.
Because that will affect the home market.
Right.
Outside that, it's all fundamentals, people.
Well, then, like you said, how are they going to affect? Because, you look at the housing issues right now, it's supply demand. Like what solves that issue? More supply, more affordable housing. People can move. Lower interest rates. Again, people can move. And I'm glad you talked about the tariffs a little bit because my understanding is that Trump proposed bringing in tariffs to help reduce taxes. And if we can reduce taxes, people and businesses can keep more of their income, have more expendable income, be able to move, use their money how they want as opposed to paying taxes all the time. That's exactly what we need. And that just looking at it full picture, how do those macroeconomics really impact us in our neighborhoods, in our communities? At the end of the day, this is really how those interest rates, that inflation going up and down, that affordability of housing for us, being able to, move into that home for our families if we need, rents, that's another thing where, Trump being, more pro-development, pro-real estate, pro-business, what are they going to be able to achieve to deregulate, to boost more development, and therefore empower the private sector to solve those issues as opposed to spending money to try to fix it.
This is where it really, and I was critical of Harris and her idea of to fix the housing market, we are going to give new home buyers $25,000.
Oh, dude, it's just
that doesn't
ridiculous.
make sense. You are increasing demand.
Yep.
And then they're like, but we're going to make a way for 3 million more homes to come to the market. The problem, though, is that doesn't happen overnight. So meaning that if you created a plan, first of all, that doesn't even get us halfway there. So that doesn't even touch the problem. But then you're giving all these new home buyers $25,000 now to go buy new homes. You're going to the demand's going to skyrocket. So prices are going to go up. They went up by $25,000. So it's what you said. I believe you want to get rid of regulation. So then you have developers that are empowered to go do it. What we need is developers to be able to do it cheaper and faster. 30% of the cost of a home today comes from regulation. 30%.
It's insane.
That's how much the Construction Association of America, that's how much they have allocated into the price of a home.
It's so
and
crazy.
A lot of that, guys, has to do with the time frame. So if we look at the data, and the home market is really obviously important to us because of all those things. I've actually made a example for the home market so we can see, and I'll try to make sure that these are up on YouTube. But when we look at California and we try to understand home prices, 1970 to basically now, they've only had a handful of years that they didn't have a massive deficit in supply for homes. Previously, from 1970 to 1960, there was a surplus, and then that switched in reverse. Now, as we can see that happening, you can look and see medium home prices in California. You compare it right up from 1970 on, basically skyrocketed, right? Where it was plateaued before that. So when there was a surplus, housing prices really didn't go up. This is basic economics, but people forget this. And then once that inversed, home prices went up and up and up until it got into a period of time after 2010 and 2020 where it just soared because there's just no houses. Now, how can we look at that as a comparison? If we look at, and what I did is I took all this data and I tried to compare it so we could have an understanding of the effects of this in the housing market. So the other one that I wanted to look at and say, all right, how would that fare was Texas. So when you looked at regulations per home, California versus Texas, they are both rising about the same. But then once again, after, the 1970s, the number of regulations per home in Texas basically topped out at like 20, where California, it got above 60. So you can see that California is like 3 times amount of regulations per home than Texas is. Now, over that, you overlay that, and it exactly overlays with the deficit of houses and housing prices. So when you look then at California versus Texas housing prices, right? You go to 1975, once again, and they break away. And the average California home got all the way up to, above 800,000 when Texas stayed below 200,000 as of 2022. That's obviously changed in the last few years. The point being, though, is it is 3 times more, the same as the regulation is time and the deficit. It isn't the regulation that made home prices go up. The regulation stopped or slowed down homes from being developed. That time frame and the cost associated, yes, but it's really the fact that the regulation made it so you couldn't build as many homes. Then all of a sudden, Texas had a surplus of home over the years. Housing prices remained low, where California did not. And the California has been so far behind, you would have to do mass development to try to counteract that and balance it. When we get in a spot, though, like this, what happens is the economy plateaus, right? You stop being able to get as much out of the economy. People can't spend as much, right? They can't move as much. Where you go to places like Texas, disposable income's higher, cost of living's lower. One of the main reasons because of housing. So people move there. So you have huge population growth. It's a main factor in the driving of people. That's why storage in places like Texas has done so incredible over the last 15 years, right? Now, places like California, storage can do really good actually, incredibly good, but it's for a totally different reason. It's because it's like a monopoly. Like if you can build a storage facility in California, it's going to take you years and the cost is going to be big, everything else. But once you get it in, like there's just not a lot of development because you can't. So the key factor there that when we look at this, when you're looking and analyzing markets and what, if anything, the government could do to try to reduce the cost of housing so more people can buy homes, live in homes, and then people would move. A vibrant housing market makes a vibrant storage market. It's getting the government out of the way, being more like Texas, reducing regulation, because people forget there is a main driver of cost, which is called a holding cost. If it takes me 3 years to build and sell a home, every year that cost to build, I have to hold, costs me money. So let's say, just a simple example, it's $200,000 and I got a 10% holding cost. That's $20,000 a year, right? 2, 4, 6 on 200,000. It went from $200,000 to $260,000 only in one aspect, holding cost. That's it. If you could reduce that down to a year, you cut it to $220,000 from $260,000. Little things like this that a lot of times we don't think about have massive impacts and trickle down effects. So whereas we go to Texas versus California, and this is the same obviously in other states, this everyone is probably the largest driver of storage and demand. Federally, once again, I'm not sure what they could do about that. We look at that almost microly. Then that tells us where housing is going to be good, where it's not moving, why people move to certain places. When we look at migration patterns, it's all about the money, everybody. It's all about the money. They go where they can have a better life, they can afford more, they can raise families, have disposable income, right? And so you have more vibrant markets. Younger people move there and you typically have growth. All of those things go into affect demand. Lowering interest rates in places like Texas creates an explosion of growth because you can build so many homes and people can move there, right? Interest rates don't have nearly as big of effect in a market, let's say like Orange County or something like that, where even if interest rates went lower, the cost to build everything else, that may get less and you may be, but the regulation keeps it tied up. You just don't see as much of a fluctuation in growth and everything else. It's just more stagnant.
Well, like you said, the supply and demand, the supply is so far behind.
You can't catch up.
Right. So that's another huge factor that even if interest rates go down, prices are still, they're going to stay and remain high to make up for that based on the limited supply.
It's not complicated. Don't give people money. Get out of their way and let them build.
Exactly right.
And they'll build homes, and that will affect housing prices, which helps us in storage. Technology is the name of the game, and how you operate your facility and the efficiency at which you can operate will depend on the technology you use. Your property management system, what it allows you to do, and what you have access will determine the outcome of how that facility performs. That's why we go with Tenant Inc. with their product Hummingbird, because they are the best in class. When dealing with automation, when dealing with move-ins, customer acquisition process, improving my online acquisition process, they are bar none the best. So if you are looking to automate your facility or operate it in a best-in-class way, make sure you guys are looking at Tenant Inc. and their product Hummingbird. The link is in the description. So this now change. There's a few things that I think are important to remember. The first thing is the change that we saw was widespread. This is a fundamental shift in the United States. We have shifted very big because we have given authority and power, which too, as was said, has been mandated by the American people. You may hate it. That's fine. The politicians got a very clear message. Very clear. We fired all you guys and we let these guys take over. So now the people that were just put in charge have heard the voice of the majority and they have been saying what they were going to do. You better believe they're going to go do it. They feel the responsibility now and the very clear mandate, that's the word that's used, by the American people to go do it. That means, though, because they control all three branches, they can get stuff done. That makes for neck-breaking speed sometimes. And I want to make it clear, I don't like that. Politically, this is my own personal beliefs. I want more checks and balances. I don't like it when one party rules all things. Why? Because I don't want the government to actually be able to do a lot. So the only time that I would want it to is if it's killing itself. So I hope that
I was going to say one exception.
One exception. And that's it. So I hope that's what we get out of it, not increased spending.
Yep.
Which the Republicans,
that's my worry.
They failed us. I mean, the Republicans and Democrats, if we're talking politically, you guys will understand very quickly. My party affiliation is, I hate politicians. I literally just feel like they all lie. And what they were designed or what they say they'll do on both sides, they have fundamentally failed us. And I think that's happened. The Republican Party has failed us since the early 2000s. They just spent their brains out, and they were supposed to be not that. We can all hope, and everybody should. I don't care. Party affiliates, it doesn't matter. That doesn't continue. That is killing us in this nation. It is the reason why we have interest rates where we do. It's the reason why we have inflation, because they spend so much money. That debt will get to a tipping point. It will, where interest rates go higher and higher. Why? Because when the debt gets so big and people are afraid that the US government can't afford it, guess what they don't want? They don't want the promise. That means they have to pay people more to get them to buy the debt so they can issue it. So the more people don't believe in the future, the more it costs us to borrow money. It's a direct reflect. We need to get that under control for the future and today. It's not just the future, but it's today. So I really hope that we see a change in that. I really do. I really hope that our politicians will focus on us, the American people. They'll get out of the way, the rest of the world. I'm tired of that. I'm tired of paying for everything. 100%. And I don't mean this to be about my political beliefs, but when we look at the shift, there's no way that you can not look at what happened and think that it's going to be the status quo. It won't be, because the American people told them not to and forced it. So there will be a lot of change, everybody. And we will be keeping you updated on interest rates, regulation, everything that's coming in, what that means, and how that's affecting the industry. Because with this change, it won't be like the previous 3 years. Good or bad, we will see. But it's going to be a fundamental different approach to managing the economy than we have seen over the last 4 years.
Right. And like you said, I'm excited to see, you'd mentioned depreciation, some of those things that will really bolster investors to get involved, and really open those investments up to people again. Not again, but continue to make them attractive. Whereas I think a lot of investors and people have looked at these things saying, oh, well, depreciation is going to be going away. I'd rather put my capital over here or over here because I can get some better returns. So just those little things that I think are really going to go a long way to really help bolster not only, individual owners and operators and investors out there, but anybody that's out there trying to raise money, trying to raise capital, get people involved and go out there and get deals done. So I think there's going to be a lot of positives. But again, could be some rocky roads before things get better. And I'm okay with that. Yeah, absolutely okay with that if that's what it takes.
And two, to be honest, everyone, we need to realize where the economy is coming from. 50% of all the jobs came from the government. The government spent $500 billion in the last 3 months, moving up to 2 months, moving up to the election. Right now, our economy literally is surviving off the government. It is where the money's coming from. It's where the jobs are coming from, right? And it's propping up other industries, everything else. Theoretically, we should have had a recession. We don't, because of the money supply and the spending and everything that's going on. Recessions are not bad. They are part of it. What is bad is the effects, everybody. And I say that because if we have a recession, that is going to directly affect my assets, me, my lifestyle, everything else. And that's hard. It's not fun. It is not something I want, but it is necessary. And it is a guarantee. You do not have markets without recessions because of what we're talking about. Recessions clean out the money. So the money supply shrinks. That actually lays the foundation to build off of. So the economy gets healthier because of it. It gets better. You cannot, though, not have contraction, get rid of the fat, and reduce that money supply and rebuild better if it doesn't go away. So the next 4 years, to expect a recession is logical. You should always expect a recession because they will always come. We just don't know when.
No, exactly right. No, a lot of good points. And too, you'd mentioned the tipping point. You look at just where the national debt is currently and what the interest alone is on that.
The amount that our government, of our tax dollars, it's something like every dollar that we have, 20, 25%, something crazy like that right now. I need to get the exact number, so don't hold me on that, but goes to paying interest on our debt. The misuse of funds for that, that is such a poor allocation for us and our government and what we get from it. It's eroding away the impact of our dollar, our ability to build, to make things better, right?
Yep.
It's not good. I don't think there's anybody that disagrees with that. I really don't. I don't care what party, none of that matters.
For sure.
Right? Like we all can agree with that. We're taxing ourselves. That's what we're doing. We're taxing ourselves and our kids. And we can do it into oblivion, not through taxes, but through debt. And we don't want that. So with that said, everybody, I don't care if you think Trump is the living embodiment of Hitler and the devil combined. You all better wish the best success for him, because if the country's not succeeding, we're all failing. So once again, it didn't matter Harris or him. We should all wish, hope for, and participate in this process to make it the best outcome possible. And we will keep you guys all along the way, all the changes that are coming, because there's going to be big ones next year.
Absolutely. And get out there, find deals, buy assets. That's
right.
Position yourselves.
That's the only way you can hedge against anything. Exactly. Buy.
100%. Thanks, everybody.
Thanks, everybody.